Welcome on board Mr. J S Gujral, the MD at Syrma SGS Technology, joining us to talk to us about their business because they've made a recent acquisition as well. Mr. Gujral, hi, good morning. Thank you so much for making time and speaking with us. Well, you've forayed into the electronic medical devices segment with this latest acquisition coming in. What's the strategy and the opportunity size that you see here?
You see, we have been evaluating inorganic acquisitions, and the principles guiding these inorganic acquisitions are primarily A, if it fulfills a gap in my product offering, or it gives me certain regulatory approval which have a long gestation period. Medical, apart from defense, is one of the growing sectors around the globe, especially in India. And we had some presence in healthcare through our RFID business, but very little in the EMS business. Now, with the acquisition of majority stake in JDHL, we get access to the US, Europe, Australia, Brazil markets. And they have about 18 products which have been approved by the FDA. The facilities are approved by the requisite certifying agencies. And we believe that with the global reach of Syrma SGS, the management bandwidth of Syrma SGS would be able to leverage the technical depth, the R&D strength of JDHL, and the two put together would be a win-win situation.
All right, so Mr. Gujral, by when will this acquisition be revenue and margin accretive, and how much do you see it adding to your top line?
You see, last year they did 160 crores. If I take the last year figure, it's a 160 crore accretive to the top line, and with about 58, 59 crores of EBITDA. Now, even if this year they grow at 20, 25, 30% or around that range, so I expect the revenues this year to be in the vicinity of between 180 to 200 crores and EBITDA of about 35%, 33, 35%, which adds up to about 65, 70 crores. So one factor which we should always keep in mind that since we are into a product business in JDHL, the revenue growth would come once more products get approved. The existing products would have a secular growth of 15, 20, 25%. But once more products are added to the portfolio, whichever period or year they come in, that will see a spike in the revenues. And we have some significant products in the approval stage at JDHL. We would be able to bring in our expertise as a top-notch EMS company. So the operating leverages, the efficiencies of the plant, because JDHL is primarily a R&D organization and based on sort of focused on technology. So with our core competency of efficient, cost-competitive manufacturing, I think it will be a win-win situation, as I said earlier.
Fair enough, but Mr. Gujral, it was a bit of a mixed performance this time around. There was very good revenue growth when it comes to your consumer segment, but health and IT were a bit sluggish. Talk to us about what is impacting the revenue for the high-margin health business.
You see, we have had a good quarter. We have grown significantly in top line, bottom line, everything. One aberration this quarter which happened was the healthcare, which had picked up in the fourth quarter of 22-23. It was very strong in Q1 of 22-23. Second and third quarters were muted. The fourth quarter, it had picked up. Unfortunately, the pickup of the fourth quarter couldn't carry into the first quarter of Q3, Q4, 23-24, and it is now spilled over to second quarter. Just to give you a reference of the figures, the healthcare business accounted for approximately 55 crores in Q1 of 22-23, 45 crores in Q4 of 22-23, and only 15 crores, less than 15 crores in Q1 of 23-24. So we see almost a 40 crore dip vis-a-vis Q1 and a 30 crore dip vis-a-vis Q4. And this is a very high margin business. Here, the gross material margins are in the range of about 40-45%. So if my turnovers in the healthcare have come down by say 40 crores compared to Q1 of 22-23, it's a direct hit of about 16-17 crores on my EBITDA margins.
So given the one-off in the health of impacting this margin this quarter, when can we expect your margins to come back to that range of 11 to 12%?
See, we have been maintaining double-digit EBITDA. That's been our sustained call right from last year. And I think if the healthcare business comes up to its expected level, we should be there at double-digit EBITDA. I don't count the chickens before they are hatched. So all the operating leverages and everything which will come will count when they come.
Okay, not counting the chickens before they hatch, maintaining a bit of a conservative view, but at least double-digit margin will be maintained. But, you know, large part of your revenue also comes from exports, almost 25-30%. How's the demand shaping up in the export segment?
Exports have grown this year also in the first quarter. And the EMS exports were predominantly to the EU. The RFID exports were both to the EU and America. As we speak, we have won a significant contract and we'll be starting the trial production later part of this year from a global multinational based out of America, which is for utility metering. So utility metering would include metering systems for water, gas, and electricity. So America business would add a leg to the export business because our current EMS exports to America are pretty low. And with this one customer coming in and 2-3 other customers in the pipeline, we expect the export business also to grow at a decent pace. Though the markets are not growing, it's only acquisition of a new business from competition or from China Plus, which is fueling the growth even in the export markets.
And given the new foray, the client additions and the growth in exports, what kind of revenue target have you set for FY24?
Still maintain the guidance which we had shared with all the stakeholders beginning of the year. That was the organic revenue targets and the EBITDA targets. We still maintain that. And the JDHL acquisition is accretive both to the top line and the bottom line. It will be more to the bottom line because of its higher EBITDA. And on the top line, it would be maybe 5-7% accretive to my turnovers or 6-7% on my turnovers. But on the bottom line, it would be sort of EBITDA margins would get up decent accretion. Now, when we had set out this year, one of the targets, apart from the revenues, margins and all that, was to bring down a working capital cycle, which was hovering at about 96 days. And I'm pleased to share that for the quarter ended June, this has been brought down to 74 days. The target was to bring it to below 80 days or around 80 days. We are currently sitting at a net working capital cycle of 74 days. So that's a very good job done by the team in managing the cash flows. As a result of this, for the quarter ended June, we have a OCF to EBITDA ratio of 50%.
No, Mr. Gujral, you said the entire context and you're maintaining the guidance for the full year. But what is the revenue target you have in mind that you've communicated to your stakeholders for the next 1 to 2 years?
See, I had said that we'll grow at a rate better than the industry. Industry is expected to grow at about 35%. So I think you can derive the figures. I would not like to commit a forward-looking statement. But if the industry grows at 35%, we would definitely grow at the industry rate or more than the industry rate. So we did about 2,000 crores last year. So that will give you an indication of what the organic growth would be. The JDHL acquisition would be additional to the top line and the bottom line.
All right, interesting. Thanks so much for giving us all of those details. That's the management then of Syrma SGS. Double-digit margins, that's what they're confident of. And they are looking at some big orders as well and smart customers as well coming in from the export markets.